It's 1986. Warren Buffett's Berkshire Hathaway is on fire. Its market cap has more than doubled over the past 2 years to over $4 billion. He has just bought a corporate jet, but in characteristically frugal fashion, he bought it used. In 1986, new corporate jets go for $15 million. Warren just bought his for $850,000. The jet takes care of the problem of traveling to places that are out of the way, but the solution to a bigger and more important problem remains frustratingly elusive. That problem is the lack of opportunities in the stock market in 1986. As a very valuation-focused investor, Mr. Buffett is finding it difficult to find undervalued stocks. In addition to a difficult stock market, he is also starting to warn investors. Berkshire's increased size will make it difficult for him to sustain the remarkable returns that he's delivered since he took over the company 22 years ago. The corporate jet is nice, but what he really wants is for the stock market to play ball. Occasionally, two very contagious diseases break out in the stock market: fear and greed. He never tries to predict the arrival of either. Instead, he tries to be fearful when others are greedy, and greedy when others are fearful. It's a discipline that has served him well. Berkshire's growing empire is helped by the fact that it is not just a collection of stocks. Berkshire also includes many operating businesses. That collection of businesses is about to grow. It's early January 1986. Warren Buffett receives a letter from a man named Bob Heldman of Cincinnati. Bob suggests they meet to discuss his family business, Fetchheimer. Despite Bob being a Berkshire Hathaway shareholder for many years, Warren has never heard of either Bob or Fetchheimer. But that is about to change. Bob Heldman is the chairman of Fetchheimer. Fetchheimer makes and sells uniforms. Bob has flown all the way from Cincinnati to Omaha to meet with Warren Buffett. Bob senses that his family's business is exactly the type of company that Warren likes to buy. Its economic record is superb, its managers are talented and passionate, and the Heldman family wants to continue their financial interest in partnership with Berkshire. In 1981, Fetchheimer was sold to a group of venture capitalists in a leveraged buyout. The Fetchheimer family retained an equity interest. The new company started with a lot of debt, but the business continued to be very successful. By the start of 1985, most of the debt had been paid down, and the value of the equity had increased dramatically. For a variety of reasons, the venture capitalists wanted to sell. Bob Heldman has been dutifully reading Berkshire's annual reports and has thought of Berkshire as a potential buyer. Warren Buffett sees an opportunity. Fetchheimer is exactly the sort of business he likes to buy. A family business with a long track record of success, run by talented managers who love what they do. Berkshire quickly buys 84% of the business at a $55 million valuation. Still not done, Warren is looking to make one more acquisition before the year is over. This time he has a small business called NHP in his sights. It's a developer, syndicator, owner, and manager of multifamily rental housing. Real estate is not a sector that Berkshire is heavily invested in, but Warren sees something here that he likes. A deal is struck. Berkshire pays $24 million for half of the business. Mr. Buffett is not finding a lot of opportunity in the stock market in 1986, but with the two acquisitions of Fetchheimer and NHP, he's found a way to continue deploying capital at attractive returns.